In this video, I want to talk about pricing power in a world with inflation, why pricing power is the #1 filter in today's market. Today, I want to show you how you can outperform the market if you focus on specific companies that have the pricing power, and why I believe it's the most important thing you should focus on when you analyze businesses. Now we live in a world with inflation, and if you don't adapt your investing style, you will fall into many traps, more traps, and you will make much more mistakes. If you only focus on companies with pricing power, you increase your chances of outperforming. I know this very well because this has been my strategy for many years now, and I've been compounding at 25% per year. In case this is your first video from this channel, welcome. My name is Christophe Noor. I'm French. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year, investing in companies with pricing power. And I believe now it's even more important than ever. So what will we do in this video? I have a few bullet points to share with you with some examples, but I also want to mention this third quarter commentary from a fund called Horizon Kinetics. They are the most experts when it comes to inflation investments, right? Inflation beneficiaries opportunities, right? I have a few comments here to highlight from the report. And I want to mention a great Twitter post from Leo Nelisen. Okay, this is what we are going to do. And let me start with the first point. Target just cut prices on 3,000 items. As you can see here from this great Twitter post, great Seeking Alpha article, Target is lowering prices on thousands of items during the holiday season. This will boost their short-term profit, but this will impact their long-term margins. This is not something that is often talked about because this is a large retailer, right? Target or Walmart or Costco or Home Depot, all these companies. Target is a company with low margins and they sell volumes, quantities that are enormous. And with the rise of inflation, their costs are going up. And the mathematical sense would say they want to increase their prices. It is not the case. At the same time, your costs are going up and your prices are going down. Why? Because the consumer sentiment is weak. The consumers in the US are suffering right now. You have a K-shaped economy. So yeah, this is the reason why they are doing discounts. So yeah, it may appear to be a short-term positive news. It will destroy them in the long term. It's not good at all, and it shows they have no pricing power. Okay, this is not a discount strategy. This is margin defense move. The consumer is stretched. And you have a great commentary from Leo Nelisen. Retailers and restaurants are unable to offset inflation. Everyone has admitted it, including Chipotle. This isn't a sign of disinflation, but desperation. And this is a great point, and I want to double down on this. Even Chipotle admits it can raise the prices. If a premium brand like Chipotle is stepping out, that tells you a lot about the demand environment. No pricing power equals margin decay. In a high-cost world, businesses that can't raise prices or reduce costs will bleed EBIT, operating income. And now I want to talk about the latest report from Horizon Kinetics. Not a lot of people know this fund. They are famous for investing in TPL, Texas Pacific Land, and they just invested in Landbridge. So they invest in inflation beneficiaries. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. Actually, they have a fund called Inflation Beneficiaries. And let me do a quick comment on this one because you can see their holdings. What's news, insight, I don't know. Horizon Kinetics Inflation Beneficiaries ETF. Okay, if you want to follow them, please check this fund managed by James Davolos, I believe. and you can check their holdings. You see Landbridge, Wheaton Precious Metals Corp, Waterbridge, Franco-Nevada, plenty of royalty plays that will benefit from inflation. Anyway, they are the most experts guys I know about inflation, and they just wrote this market commentary that was released a few days ago actually, and here is what they have to say about inflation and how you should invest in a world with inflation. Because if you are watching this video, watching this channel, you want to outperform the market, right? You want to invest the smart way in stocks to, one, preserve your capital, and two, beat the market. These are the two reasons why you are watching my channel, and I believe this commentary will help you a lot. Okay, so they have a comment about, is there inflation? You're gonna believe the CPI or your lying eyes. So they talk about the CPI, the consumer price index. They talk about the price of beef that is changing, and they talk about the behaviors that are changing. Actually, instead of looking at the CPI to measure inflation, they give you an example of the Big Mac index. It's a measure of inflation. It's a metric you can track since the 80s to just see if inflation is rising or not. And actually, even for the Big Mac index, you have differences between states in the US. Yet the Big Mac index is also problematic. As of April of this year, so 2025, the average pre-tax price of that commodities on urban construction range from $4 in Texas to $6 in Massachusetts, a 40% differential. Okay, so for the past 12 months, through August 2025, the CPI increased by 3%. This is what you can see on major headlines from CNBC, on YouTube, etc., etc. Officially, the inflation rate is 2.9%, 3%. For the 12 months through this August, the restaurant industry's total food away from home category experienced menu price inflation of 4%, and for full service restaurants, 4.6%. So if you look at real life metrics, the inflation rate is higher. And I suppose you are seeing the same thing with your grocery prices, right? Things are continuing to increase in prices. The 16 months average Big Mac price from year-end 2023 to April 2025 is up an annual 9%. Okay, so they say the restaurant sector is very important because it impacts the US workforce, real estate rental costs, supplies purchases, and so forth. A problem in the restaurant industry is almost by definition a problem for the US economy. What they say is, instead of looking at the normal official CPI metric, please look at what is happening in the real world, including the restaurant industry, because the restaurant industry covers many layers of the economy. The workforce, the price of electricity, the rental cost, the price of beef, the price of commodities, the price of coffee, the price of anything, right? The price of eggs, funnily enough, fluctuating a lot. So you want to monitor what is happening for the restaurant index. Moreover, the above figures underreport inflation. Restaurants have not raised their menu or output prices as much as the input prices they pay. This is what we've been saying for Chipotle just before in this video. The reason is that limited service restaurants, fast food restaurants in civilian parlance, assert that their customers resist menu price increases in proportion to the menu inflation rate. Price increases result in diminished traffic. The inability to raise prices will naturally result in compressed profit margins. And then they give you an example of McDonald's and other quick service restaurants companies. Basically, what they are saying is the cost of operating a restaurant, the price of beef, the price of electricity, the rental costs are going up more than what is shown in the CPI inflation rate. And at the same time, the restaurants company can't increase their prices, okay? Because the consumer is weak, because people don't want to pay an expensive meal if you go to the restaurant. So a good way to invest would be to avoid investing in restaurant companies, because by definition, they don't have any pricing power. And this is why I'm making this video today. If you want to invest in a world of inflation, you have to see these things. If their costs are going up, are you able as a company to raise your prices minimum as much as your costs? If your costs are growing by 5% per year, can you increase your prices by 5% per year? Well, most restaurants can't. This is the TLDR of this article. Most restaurants can't. But now, if you look at your portfolio, maybe you are invested in restaurant companies or car makers or other companies, you can do this exercise. Are my companies growing their prices at the same rate as their costs? And if you don't fall in this category, if you can't raise your prices, you will suffer because your margins will go down. And if your margins go down, your earnings will decelerate and the earnings per share growth will decelerate and your stock price performance will falter. So a simple way to invest is to reverse the formula. As Jacobi would say, invert, always invert. If this is what you want to avoid, what can you invest in to benefit from the situation? Well, you can benefit by investing in companies that have minimal cost increases, but maximum margin improvements. Okay? So by inverting the formula, you get what you deserve. Okay? No pricing power equals margin decay. In a high cost world, businesses that can't raise prices or reduce costs will bleed EBIT. It's not just Target or Chipotle. Dollar General, McDonald's, Starbucks have all hinted at margin pressure from weaker consumer elasticity in recent earnings. People are not willing to pay up to eat at Starbucks, to drink a Starbucks coffee. People are not willing to pay up to have a burger of $20. No, this is also the reason why McDonald's introduced a $5 meal. Well, it's a cheap meal, but the quantity is much lower, right? So yeah, seems like the restaurant industry is struggling, trying to innovate with new menus, for example, to just stay resilient in this world. But eventually, as inflation increases, you will have to pay $20 for a burger. In a couple of years, it will be the case. Now, good point. Good brand is different from pricing power. A moat only matters if it protects profits, not just market share. And I have plenty of examples for you. You can check Nike, Adidas, McDonald's, Starbucks, Chipotle. If you look at their brand power, how famous these brands are, maybe some people will say, yeah, it's a resilient brand, so they can price up, they can increase their prices very well. The reality is no. Strangely enough, McDonald's can't increase their prices by a lot. And this is also the reason why margins are struggling to go up for McDonald's. You can check this. Margins are either stable or declining a little bit in recent years. They can't keep up with inflation. Same thing with plenty of restaurant companies. Again, look at your portfolio right now. See if you have a good brand and see if they have pricing power. True pricing power equals flat or rising margins in high inflation. You can look at the ROIC, return on invested capital, and the EBIT margins, so operating margins, during Q3 or during the whole year of 2025 actually. If they are down while the cost of goods sold is up, this is a red flag. So, if I can give you some homework now. You can check all your holdings in your portfolio. You can check the growth rate of the COGS, cost of goods sold. This is your revenue minus COGS, that's your gross profit. So that's at the beginning of the income statement, right? You can check the growth rate for the past 1, 2, 3 years of the COGS. And you compare this with your EBIT, I would say, with your EBIT margin for the 1, 2, 3 past years. And you see if these trends are in the same direction, if the COGS are skyrocketing and the margins are down, or if the reverse is true. For some companies, the costs are down and the margins are skyrocketing. And now you can spot the reason why I am making this video. In a world with inflation, if you think inflation will continue at the same pace for next year, for the next 2 years, 3 years, You want to only be invested in companies with pricing power that are improving their margins as the world is more expensive, right? So you want to avoid bad industries with a lot of costs. You want to only invest in companies with very high gross margins. And now let me go to the next point. This is why I prioritize unique economics over narratives. I want stable, high ROIC, and proof of repeatable demand. No exceptions. My portfolio is public, by the way. There is a link in the description to check my portfolio on eToro. Every day you can check my portfolio. You can see what I'm buying, what I'm selling. I like this level of transparency. So you can check everything in real life. You can check my performance, etc., etc. The portfolio I have has very high margins overall, high ROIC overall, high efficiency, high quality management teams. And I want it to be this way for a few years because I believe inflation is here to stay. Inflation is underreported. If you look at the CPI, I think inflation is much more than this. So you only want to be invested in companies with increasing margins, increasing efficiency. And this is the reason why I'm making 25% per year. Because of this. And actually, stable margins, high ROIC, proof of repeatable demand. Even if we don't live in a world with inflation, these are 3 attributes of quality businesses. So even if there is a scenario where, I don't know, in 2 years inflation falls down because we have a crisis or for some reasons, these 3 characteristics, these 3 attributes are very, safe, sound principles of quality investing. So best case scenario, we have inflation and I am hedged because I invest only in these companies. Worst case scenario, you have disinflation and these are still quality companies, right? You see how everything is working out and the reason why I preach quality investing on this YouTube channel. And the last point for today's video is to avoid businesses that rely on strong consumer. That's not a strategy, that's hope. And hope doesn't compound at 10, 15, 20% per year. If your whole investment thesis is that it's a turnaround play and the consumer will get stronger again, you're just lying to yourself. Because if you look at the track record, if you look at the past, you don't have such scenarios. Very unlikely that suddenly the consumer will be in a great shape in 6 months and they will consume go to the restaurants and consume much more. So yeah, hope is not a strategy. The strategy is to only invest in quality companies that have pricing power. This is why I think pricing power is the #1 filter in today's market. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.